Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to helping investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to session 10 of Money Simplified, your guide to money and mutual funds. We are glad to have you with us for the 10th session on Introduction to Mutual Funds, its benefits and regulatory structure. Alright, so now let's get started with this session. Many investors at times are absolutely fascinated about investing in mutual funds. But in our opinion, mere fascination is not enough. Investing wisely and with the right insight helps one to make right investment decision. If you do not have the right perspective, mutual fund investing could be a challenge. If you are not cautious, then you could easily go down the wrong path, reaching the unwanted destination. Hence, it is imperative that you understand the various aspects about mutual fund investments, and from this session, we start guiding you on various aspects that you should know when it comes to mutual fund investing. So let's start with understanding the term called mutual funds. A mutual fund is a legal vehicle that enables a collective group of individuals to create pools of investments by pooling their surplus money and collectively invest in stocks, bonds, and other securities for a common investment objective. Each pool of money is called a mutual fund scheme, which may have a different investment objective based on investors' needs and preferences. Mutual fund assist in earning income or building wealth. This is a primary investment objective which is achieved by participating in opportunities available in various securities and markets. Utilize the knowledge and experience of a professional fund management team, a capacity that individual investors may not possess. Mutual funds provide the benefit of economies of scale as facilitated by large size of pool which otherwise may not be available to you as an investor on an individual basis. So investing in a mutual fund is like investment made by a collective group of individuals who may have lesser amount of money at their disposal than say a group of friends put together. So to simply put, a mutual fund is the money pooled by a large number of investors and offers an opportunity to invest in a diversified and professionally managed basket of securities at a relatively lower cost. So why should you invest in mutual funds? First, they are easy to understand. If you are aware of the broader asset classes where mutual fund invest your money, you could easily understand your mutual fund scheme. They enable you to earn income or build wealth. Mutual funds are a simple tool that can help you easily allocate your money across various asset classes such as equity, debt, or gold based on your objective or planned allocation. Mutual funds offer various avenues to invest in, such as regular income generating debt instruments or building wealth through investment in equity instruments. They offer choice of various categories of scheme under each asset class to suit your investment objective and varying needs for various financial goals. They help you access to ready investment portfolio and past track record. As mutual funds invest in and build a portfolio of securities, you as an investor can know where your money is invested. The past performance track record of a mutual fund scheme can help you judge and compare the mutual fund scheme vis-a-vis the benchmark index and peers before investing. For regular and disciplined investing, mutual funds have a route called the systematic investment plan where you can invest regularly. Via SIPs, you can commit a portion of your money saved every month or quarter towards your financial goals. It inculcates financial discipline and may even help you in the long-term wealth creation. Mutual funds help you render service of investment professionals. It is worth mentioning that through mutual funds, you can easily render the service of investment professionals at relatively low cost, irrespective of the size of your investment portfolio. As many of you may not be well equipped to closely track the developments in the markets and draw its impact on your portfolio holdings, the professional manager will do the same for you. So what do you get as a mutual fund investor? You get the status of a unit holder in the scheme. When the investor invests money in a mutual fund scheme, In return, he receives units of the scheme. You as a mutual fund investor will hold units of the respective mutual fund schemes. The number of units held by you basically represents the fraction of the fund that you hold based on an investment amount. Unit, certificates or statements of accounts is what you obtain. As a mutual fund unit holder, you receive unit certificates or statement of accounts confirming your title in the respective mutual fund scheme. You can store it as a proof of your investment and refer to it for details like folio number, balance units, holding status, etc. for future transactions. Share in gains or loss in value of mutual fund scheme. Any increase or decrease in market price of the underlying instrument impacts the value of the mutual fund scheme and so the value of the mutual fund investments. The post-expense profits due to appreciation in value or loss due to depreciation in value is passed on to the unit holder in proportion of the number of units held by each investor. Benefits of investing in mutual funds. So what are the benefits of investing in mutual funds? Number 1, diversification. By putting your money in just a few stocks, you can subject yourself to considerable risk. Any major decline in single stock can have an adverse impact on your investments, damaging the returns of your portfolio. A mutual fund, by investing in several stocks, tries to overcome the risk of investing in just 3 to 4 stocks. By holding, say, 25 to 30 stocks, the mutual fund avoids the danger of one rotten apple spoiling the whole portfolio. A diversified portfolio of a mutual fund may fall to a lesser extent even if a few stocks fall dramatically. Also, a mutual fund's NAV may certainly drop, but the mutual fund tends to not fall as freely or as easily as stocks. Then the second advantage you have is professional management. Active portfolio management requires not only sound investment sense but also considerable time and skill. By investing in a mutual fund, you as an investor do not have to track the prospects and potential of the companies in the mutual fund portfolio. This is already being done for you by skilled professionals appointed by mutual fund houses. These are the professionals whose job is continuously research and monitor these companies and take appropriate measures for the benefit of investors. The third advantage which mutual funds offer is lower entry level. There are very few quality stocks today that investors can buy with Rs 5,000 in hand. This is especially true when valuations are expensive. Sometimes with as much as Rs 5,000, you can buy stocks of just a single company. In case of mutual funds, the minimum investment amount required is as low as Rs 500. This is especially encouraging for investors who start small and at the same time take exposure to funds portfolio of 25 to 30 stocks. Economies of scale. By buying a handful of stocks, the stock investor loses out on economies of scale. This directly impacts the profitability of their portfolio. If you as an investor buy or sell in stocks, it may impact your profitability. On the other hand, in case of mutual funds, frequent voluminous purchase sales results in proportionately lower trading costs than individuals, thus translating into relatively better investment performance. Then the next is flexible and innovative plans for investors. Mutual funds offer various innovative plans like the Systematic Investment Plan SIPs, Systematic Transfer Plans STPs, Systematic Withdrawal Plans SWPs, Asset Allocation Plans, Trigger Plans, etc. As these plans can help you systematically invest or withdraw funds according to your needs and convenience, they can be an effective tool for you to efficiently manage your portfolio from a financial planning perspective too. Liquidity. The best feature your investments can offer is the access to your money when you need it the most. Mutual funds can offer the much required liquidity while investing. In case of open-ended fund, you can buy or sell at the day's NAV by simply approaching the fund house directly or by approaching your mutual fund distributor or even by transacting online, and you get the money back generally within 3 to 4 working days. Transparency. You may not always be comfortable when it comes to handing over your money to someone else. You need to know what is happening with your money. In case of mutual funds, your money is handed over to investment professionals whose job is to keep a track of developments in the capital market and look out for best opportunities for you. Moreover, the monthly fact sheets published by mutual funds can help you regularly track and know the facts about the schemes in which you have invested in. It provides you the holding details of the scheme in which you have invested your money, percentage of exposure in top 10 companies, the rating of debt instruments in your portfolio, fund manager's name, performance data, etc. Apart from this, the NAVs are disclosed by the fund houses may help you know the current value of your investments. Mutual funds have a well-regulated structure. All mutual funds are registered and monitored by the regulatory body Sebi. Mutual funds have to function as per the regulations designed to protect the interest of investors. So you need not worry much about the investments in mutual funds being in safe hands. So, on account of the advantages which mutual funds offer, they have emerged as an immensely popular investment avenue, especially for retail investors and for investors looking to build wealth over time. Now let us see what is the regulatory structure of mutual funds in India. Securities and Exchange Board of India is the regulatory authority for the Indian mutual fund industry. Sebi aims to protect the interest of investors, and in order to do so, Sebi has consistently introduced several regulatory measures. It has framed the Sebi Mutual Fund Regulation 1996, which is the principal regulation for the mutual fund industry in India. As the regulator of the Indian capital market, Sebi had framed its first mutual fund regulation in 1993. In these guidelines, Sebi expressed the need for creating compliance mechanism for functioning of mutual fund industry. These regulations were revised and enlarged subsequently in 1996. Sebi Mutual Fund Regulation 1996. To understand the legal structure of mutual funds in India, let us take a look at how Sebi Mutual Funds Regulation 1996 has defined mutual funds. Sebi Mutual Funds Regulation 1996 defines mutual funds as: mutual fund means a fund established in the form of a trust to raise monies through the sale of units to the public or a section of the public under one or more schemes for investing in securities, including money market instruments or gold-related instruments or real estate assets. So what are the key features of mutual fund as per its defined structure? Mutual fund is established in the form of a trust. Mutual funds raise money through sale of units to the public or a section of the public under one or more schemes. Mutual fund schemes can invest in various instruments. They can invest in various instruments such as equity, debt, money market instruments, and gold-related instruments, as well as real estate. Now let us learn what are the key constituents of a mutual fund. When we talk about the constituents of a mutual fund, the Indian mutual fund industry follows a three-tier structure as shown here. First, you have the sponsor. Then under that you have the trust, and under the trust you have the asset management company. Let's understand each of these in detail. Sponsors. Sponsors are individuals or entity who initiate the process of formation of a mutual fund. For registration of a mutual fund, the sponsor approaches Sebi. Not everyone can start a mutual fund. Sebi grants permission to start a mutual fund only to a person of integrity, having sound track record and reputation, having significant experience in the financial sector, a certain minimum net worth, etc. Sponsors are the main people behind the mutual fund formation. Trust. Once Sebi is satisfied with the credentials and eligibility of proposed sponsors, the sponsors then establish a trust under the Indian Trust Act 1882. Trustees are individuals or entity authorized to act on behalf of the trust. Contracts are entered into in the name of trustees. Once the trust is created, it is registered with Sebi, after which this trust is known as the mutual fund. Trustees have a significant role in ensuring that mutual fund complies with all the regulations and protects the interest of investors. Asset Management Company. The trustees then appoint the AMC, which is established as a legal entity to manage investors or unit holders' money. The AMC handles the day-to-day operations and money management. In return for the money management on behalf of the mutual fund, the AMC is paid a fee for the services provided. This fee is borne by investors and is deducted from the money being managed. Also, in all its investment decisions, AMCs are required to exercise due diligence and care. Before we move ahead, let us tell you about an important body in the Indian mutual fund industry, the Association of Mutual Funds in India. AMFI, an industry body, is created to promote the interest of mutual funds in India. All AMCs in India are members of AMFI. Its role is to maintain high professional ethical standards in all areas of operations of the Indian mutual fund industry. To maintain ethical standards, AMFI has set up AMFI Code of Ethics, which is to be followed by all AMCs. AMFI has also set AMFI Guidelines and Norms for Intermediaries (AGNI), which are the guidelines and norms for mutual fund distributors in India. So AMFI recommends and promotes best business practices and code of conduct, which need to be followed by members and entities engaged in the mutual fund activity in India. AMFI interacts with Sebi and represents the Indian mutual fund industry to Sebi, government, RBI and all other bodies on all matters pertaining to the Indian mutual fund industry. Also, there are some other service providers in the Indian mutual fund industry. Custodian. Custodian is an entity appointed by the mutual fund to hold the custody of assets of a mutual fund scheme. The custodians needs to accept and give delivery of securities for every purchase and sale transaction by a mutual fund scheme. Registrar and Transfer Agents (RTA). An RTA is an entity registered with Sebi and is appointed by the AMC for handling documentation and maintaining the records of the mutual fund investors. While many AMCs appoint RTA to handle transactions, some AMCs handle this activity in-house. Auditors. The accounts of the mutual fund schemes need to be regularly audited by independent auditors. As per guidelines, the auditors appointed for the audit of the scheme accounts need to be different from the auditor of the AMC. Fund accountants. AMCs need to publish their net asset value (NAV) of all mutual fund schemes on regular basis. This role of calculating the NAV of all mutual fund schemes is performed by the fund accountants. Mutual fund distributors. AMFI registered mutual fund distributors play a role in selling mutual fund schemes to investors. To be eligible for distribution activity, mutual fund distributors need to pass the prescribed certification test and get registered with AMFI. Collection bankers. AMCs appoint collection bankers for accepting application forms for the schemes. So far, we have learnt about mutual funds and its benefits, its constituents and the regulatory framework set up for the mutual fund industry, which is aimed for the protection of investors' interest. Now let us quickly wrap up this session by reviewing some important points about mutual funds that you must keep in mind. Key points to remember. Mutual funds are established in the form of a trust. Mutual funds are collective investment vehicles. They mobilize money from investors and invest in various securities and asset classes. Mutual funds assist investors in earning income and build their wealth by investing in various asset classes like equity, debt, gold, etc. Based on invested money, mutual fund investors get a proportionate share in a mutual fund scheme and are called unit holders. Any profit or loss made by a mutual fund scheme is proportionately shared by unit holders. Mutual funds offer several benefits like diversification, economies of scale, professional management, transparency, liquidity, etc. Sebi is the regulatory authority for the Indian mutual fund industry. Sebi aims to protect the interest of investors and has framed the principal regulation for the mutual fund industry in India. Sponsors are individuals or entity who initiate the process of formation of a mutual fund. Trustees of the mutual fund appoint the AMC to handle the day-to-day operations and money management. AMFI is an industry body created to promote the interests of the Indian mutual fund industry. The role of AMFI is to maintain high professional and ethical standards in all areas of operation of the Indian mutual fund industry. Hope our session today has provided you with good insights about mutual funds, the constituents behind its functioning and its regulatory structure. And to end our learning session today, we invite you to test your learning by taking up this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.